Hi there. Welcome back to Money Managers, a User's Guide. I'm Nathan Peters. A couple weeks ago, I reviewed a scrappy little fund called Aperture, who is trying to align its incentives with those of investors through a performance fee. I've included a link in the description below if you haven't yet seen that video and want to check it out. As I said then, it's a ballsy thing to do in the money management business. It really is a David versus Goliath attempt. So I thought to myself, with news this week that the iShares passive behemoth BlackRock is rapidly nearing $8 trillion in AUM. What is the biggest active management shop out there? That is, who would be the true Goliath to Aperture's David? Well, from the title of this video, you know who it is. Capital Group, which currently runs just under $2 trillion in AUM. I believe they are the largest pure play active manager, and from their website, it is clear that their business model has to be fairly unique in order to handle all those assets and still credibly claim that they are active. In summary, Capital Group carves up their portfolios into smaller sub-portfolios or sleeves, and they let each sleeve manager make concentrated stock-specific bets so that these best ideas roll up into a more diversified overall portfolio. Importantly, all these managers are not part of a unified research process, and there is no chief investment officer, allowing for a diversity of thought and conviction to gain expression. Sounds great in theory, and they obviously have capitalized on this. However, I think a hard look at the numbers will convince you that what has occurred here is a prime example of misaligned incentives, leading to poor relative outcomes for clients and fabulous riches for the manager. So without further ado, let's dig into Venn and see how the Capital Group does for its clients. I've taken the 10 retail US equity funds they run from their website, and I've had a mild heart attack as I've realized they run almost $1 trillion just in US equity mutual funds alone. That's just slightly less than the Vanguard Total Stock Market ETF, which I've used as the benchmark for this group of funds. For those keeping score at home, the tickers on the left are, and I'm going to do this quickly, AWSHX, AIVSX, ANCFX, AMRMX, SMCWX, NEWFX, ANWPX, ANEFX, AGTHX, AMCPX. I'll include those tickers in the description below as well for your reference. The first four are labeled growth and income funds, and the last six are just growth funds. So when we look to Venn, right away we see that all this effort has underperformed the market over the last 5 years, while taking a 3.7% tracking error, so relatively little active risk. The correlation, I can tell you, is an uber high 98%. So they don't stick their neck out much, do they? If we dig a little deeper at the individual funds, only the Growth Fund of America at the bottom here outperforms the Vanguard Total Stock Market ETF, which is a reasonable excess return of 3% for its fees, although that is primarily because it is one of the growthiest or most anti-value of the bunch, and not because they pick such great stocks. Going back to the portfolio, let's move down and see where all this underperformance comes from. Over 3-year trailing regressions on daily returns, we see a sea of brown underperformance by factor, with a shot of green outperformance coming from that anti-value bias. The residual line has been positive in the past, just not over the past 3 years, when stock picking after all other risks incurred loses about 1% per year. Now this is somewhat shocking given that when you run $922 billion at an average expense ratio of 74 basis points, you earn about $6.4 billion for losing your clients 1% per annum versus the Vanguard Total Stock Market ETF, which, by the way, costs 3 basis points, which nets Vanguard only $280 million, So, Capital Group and their service providers make 22 times more than Vanguard's for losing its clients 1% a year versus Vanguard, all the while not taking any risk of deviating too greatly from these outcomes. I mean, that's like Gucci charging you $220 for a $10 t-shirt made in Vietnam. Only with Capital Group, no one knows you own it, and no one would care if they did. So I guess the only question to ask now is, why does Capital Group exist? With perfect information, they wouldn't, I would argue. But there is where we have our answer. Because those 22 times fees I told you about, well, that's only a fifth of the total fees you'll pay if you're a typical retail investor. Because the sales loads that advisors get for selling the fund to you can rise to something like 5%. It is a situation in which the distribution channel creates your demand and then sells your demand back to you. Let us tell you how you're going to make us rich, in essence. Did you like the story earlier about the glorious diversity of ideas at Capital Group? Well, I hope you did, because that might just be the most expensive story ever told in the world of finance, when those exquisitely managed and justified portfolios end up looking just like the market portfolio. Thanks for making it this far with me today on Money Managers, A User's Guide. If you enjoy this content, hit the like button, comment, subscribe, and hit the bell for notifications. Thanks.